Hi. Chapter 12 takes a kind of a quick look at some miscellaneous property transactions and how we handle them from a tax perspective. The first one we're going to look at is called like-kind exchange. There are three criteria for like-kind exchanges. They must be an exchange, obviously, and the property transferred and the property received must be held for productive use in a trade or business or for investment. Essentially, that's the definition of like kind per the IRS. Exchange rules are not elective. So, other rules. A dealer does not qualify for like kind exchange treatment, and only real property, so we're talking about land and buildings basically, used in a business or held for investment can receive the like kind treatment. So, what is a like kind asset? Has the same nature or character, both pieces of both assets, and they have the grade or quality doesn't have to be the same. Now there's something also called boot property. Boot is something that's been used for centuries with regards to sales and transactions. Boot is any extra consideration given or received other than the like kind property. So it's an incentive to make the trade. Recognized gain with regards to like-kind exchange is the lesser of the fair market value of the boot received or the realized gain on the exchange. And remember, receipt of boot causes a recognition of gain, and giving boot does not cause the gain recognition. So we're going to talk about the basis. What is the basis of the property received? The basis of the property given plus the basis of any boot given, if there is any, plus the gain recognized less the boot received. Or you can just use the fair market value of the property received less any deferred gain. The time periods are important here. You have 45 days to locate replacement property and 180 days to actually receive that property. The release of a liability is considered boot, and the presence of a liability can trigger a gain. So, with a correctly executed like-kind exchange, gain is never recognized unless the taxpayer receives boot. True or false? Answer is true. Number two, for a transaction to qualify for a like-kind exchange, an exchange of assets must occur, and the assets must be held for trade or business use or investment and be like-kind assets. True or false? That is also true. A taxpayer has 180 days after relinquishing his or her property to identify a replacement property. True or false? No, that's actually making the exchange. The taxpayer has only 45 days to identify the replacement property. And number four, the basis in the replacement property is typically fair market value of the property received less the gain postponed, and that is true. The second idea we're going to look at is called involuntary conversions. This is where property is destroyed or stolen, or the county condemns the property, and the taxpayer receives similar property or proceeds, say from an insurance. They defer the entire gain. The replacement property must be purchased for an equal or greater amount than the proceeds. Replacement property must be similar or related in service or use. These rules are more restrictive than the like-kind test that we talked about previously. Real property can only be like-kind. The replacement period, 2 years after the close of the tax year, 3 years for real business property. Again, we're talking about business, about land and buildings there. Basis of replacement property with regards to the involuntary conversion, the basis of the converted property, less any money not used to replace it, plus money reinvested in excess of the proceeds, plus any gain recognized, less any loss received. Now, the holding period of replacement property includes the holding period of the property that was converted. It's an important point. So let's take a look at a couple of examples. Assume the following facts to answer the following questions. A fire destroyed Andrew's building used in his woodworking business. He had purchased the building several years ago for $75,000, and it now has a $50,000 adjusted basis. So Andrew received $105,000 in insurance proceeds for the replacement cost. If Andrew does not replace the building, what is his taxable gain? His taxable gain is going to be 55 grand. It's the difference between the adjusted basis, the $50,000, and the proceeds from the insurance. Number two, assuming the same facts as above, how many years does Andrew have to replace the building in order to defer recognized gain? Because it was real property used in a business, he gets 3 years. Number three, installment sales. In accounting, we talk about installment sales in a different concept, but it's similar here. A disposition of property where at least one payment is to be received after the year of sale. So an installment sales typically says you're going to make payments. It's like a credit card, for example. Installment payments or buying a car is an installment agreement. Installment payments consist of three components. There's interest income, return of basis, and gain on the sale. And we're dealing with something called the gross profit percentage here. It's going to be a very important part of the calculations. Gross profit percentage is gross profit divided by the contract price. And we're going to see how we calculate gross profit in a minute. Dealers cannot use the installment method. It also cannot be used on the sale of publicly traded stock. And any depreciation recapture is recognized in the year the asset is disposed. So our example here is Tamarius sold a tract of land for $30,000. The land has a basis of $18,000, and she incurred $2,000 of selling expenses. Tamaria received $5,000 down and will receive 5 additional annual payments of $5,000 each. What is her gross profit percentage on the sale? Well, we come down here. I thought we were coming. There we go. We take the sale price of $30,000 and we're going to subtract from that the adjusted basis of 18 and the selling expense of 2. That's going to give us a gross profit of $10,000 divided by the sale price of 30. That gives us a gross profit percentage of 33.33%, which is A. All right, number 4, sale of residence. This means your primary residence. Married taxpayers can exclude up to $500,000. It's $250,000 for each, because you get $250,000 as a single, $500,000 as a couple. Exclude up to $500,000 of the gain on the sale of their personal residence. By the way, this provision is an exclusion, not a deferral. So you're actually excluding $500,000 of gain. During a 5-year period before the sale, the taxpayer must satisfy ownership test, meaning owned the home for at least 2 years, and use test, lived in the home as the main home for at least 2 years. The tests do not have to be continuous. The exclusion applies to only one sale every 2 years. And if for health or employment reasons, a reduced exclusion is available if a second sale based on the ratio of days owned divided by 730. Which, by the way, 730 is 365 times 2. All right, so if married taxpayers live in their personal residence for more than 2 years, the couple can exclude the gain on the sale of their residence up to 500 grand. That is true. A taxpayer cannot exclude any gain on the sale of a residence if he or she has lived there less than 2 years. That's false. See that exclusion we spoke about earlier. Number 5, related parties losses and wash sales. Losses on sales between related parties are disallowed, and we can understand why that would be the case. Related parties include family members and more than 50% owned entities. Constructive ownership rules apply. So the loss disallowance does not affect the basis of the property to the buyer. Now, a wash sale rules disallow a tax loss where the ownership of a company is not reduced. So a wash sale occurs if essentially the same stock is purchased 30 days before or after, or 30 days after the sale, which is what the wash is, 30 for 30. Leslie sold 500 shares of Bluff Company to her brother for $5,000. Leslie purchased the stock 3 years ago for $7,000. How much of the loss can Leslie deduct on her tax return in the current year? $0. We go back here. Wash sales disallow a tax loss where the ownership of the company is not reduced. Would the question to number 1 change if Leslie sold the stock to Leslie Company instead of her brother? Explain assuming the following facts. Assume Leslie owns 25% of the outstanding stock in Leslie Company. For A, Leslie could deduct $2,000 in capital losses. That's the difference between the purchase price and the actual sale price. Assume Leslie owns 75% of the outstanding stock. The answer is 0. She loses that. What is the purpose of the wash sale rules? The purpose of the wash sale rules is to disallow a tax loss where the ownership of a company is not reduced. Thus, if a taxpayer buys similar stock within 30 days of a stock sale, any loss on the sale is disallowed. It's requiring that there actually be a real change in ownership is what we're talking about here. And that's it for this chapter 12. Please, again, if you have any questions, contact me. I have been getting some text messages, and I've done a couple of Zoom meetings with your classmates. If you have any questions, get in touch with me. I'm here for you. Have a great week.